All right. Today is Monday, July 12th or 12th. This is a recap for the stock market activities today. Before we start, a word of thank you to those who clicked the like button on yesterday's video. I asked you to do so and you delivered. You guys are the real apes. You see how easy it is? Oh my god, what an effort to move your fingers around and click the like button. God forbid you lose some calories on your fingers. But you know what's going on in the world these days? The new epidemic of fingers obesity, also known as digits obesity. And the solution is to move your fingers around and click the like button. Trust me, that's the solution. Not to mention for you gents, the ladies like strong fingers, and this is one way to accomplish that goal. You know what else is good for your fingers? Disabling your ad block or whitelisting the channel and watch whatever garbage they show you for 3 seconds and then skip. That way your view counts and we make a few fazulis out of your view. And I know some people don't care. You know what? I don't like this guy anyways. I just want to watch a couple of charts, few tickers, and who cares? That's okay too, but understand I might spit in your tickers. So just be careful here.
Here you go, guys. Yeah. Yeah. Have a good time. Chill. Hey, how you doing?
Anyhow, I'm keeping this intro short and sweet because we have a long conclusion, because we will preview the CPI number. I will show you all the data that I have regarding the components of the CPI and what to expect regarding the market's reaction if the number comes out too hot or too cold. Regarding the market, we're continuing on the theme from Friday. Yields continue to rebound higher, the Dixie is weakening, and we're seeing the inflationary trade leading the market once again. But things will start to change starting tomorrow, as we shift from the technicals back to the fundamentals and inflation data. With that being said, let's move on and cover the market's performance today. And here we go. The Dow Industrial Average closing in the green by 126.2 points, or a gain of 0.36%. The Nasdaq closing in the green by 31.32 points, or a gain of 0.21%. The S&P 500 closing in the green by 15.08 points, or a gain of 0.35%. What about the sector's performance today? Leading the pack at number 1 and capturing the gold medal, financials at number 2 for the silver, real estate number 3 for the bronze, communication services. Of course, financials are catching a bid in anticipation of banks' earnings, and I will review all of those, or shall we say preview all of those, in the conclusion of this video. The laggards of the day led by energy, consumer defensives, and technology. What about the advanced decline ratio? We're normalizing once again. The breadth was awful throughout last week, and we saw a massive rebound on Friday. Now the market is stabilizing to around 50-50. The NYSE 55% advancing versus 43% declining. The Nasdaq 46% advancing versus 51% declining. Moving on to futures, what's going on here? Starting with crude oil, of course, we're seeing a retreat here, a modest one, for both the WTI and Brent. They were much lower earlier in the morning, but closing the session with modest losses of about 0.5 percentage point. Meanwhile, the rally in natural gas goes on. What about softs? Coca continues to rise higher, along with coffee and cotton futures all closing in the green today. Meanwhile, lumber, sugar, and OJ closing in the red with losses for today's session. What about metals? The US dollar is weakening. It did not reverse 100% yet, keyword yet, and this is a positive catalyst for metals. We're seeing platinum, palladium, and silver closing in the green. Meanwhile, gold stable on the flat line, copper giving up some of the gains from Friday's session. What about meats? Here comes the new tech. Lean hogs rebounding higher, perhaps bottoming as we expected. We saw lean hogs futures closing in the green by about 2.5% today. Likewise, gains for live cattle futures. Meanwhile, feeder cattle futures closing slightly in the red. What about grains? Massive gains for grains led by canola, wheat, oats, corn, soybean oil, soybean meal, and rough rice futures. Every single one of these closed in the green today. And most of you are aware that I am bullish on oats in specific. And we have more data regarding oats. The USDA cuts U.S. oat production to the lowest in data, going back to 155 years. So this is the lowest harvest in oats in over 155 years. The expectations are that we will see a massive shortage in oats, and that should be a catalyst to drive oats prices higher. Now, oat milk is becoming America's favorite milk because, number one, it is environmentally friendly and it is easier to produce than, say, almond milk. The prices of almonds are rising significantly higher due to the drought in California. But don't expect any relief here because oat milk prices are also projected to rise higher. Whether you want to switch from dairy to plant-based, doesn't matter. The prices of milk are rising higher across the board. But for oats in particular, this is the bullish catalyst. The dry conditions after years of falling oats acreage as U.S. grain growers swapped it out for more profitable crops such as corn. This year's low harvest compares with a peak of 1.15 billion bushels back in the 1960-61 season. There will be very few supplies left after this year, says oat farmer. And even wheat prices are rising significantly higher. Wheat soars as drought from U.S. to Kazakhstan crimps supply. With the U.S. growing fewer oats, buyers are heavily dependent on imports, mostly from Canada. But that country is also suffering from dryness. Canada's oat harvest this year could total about 268.7 million bushels, down nearly 15% from a year ago. One saving grace might be more consumers going back to restaurants for breakfast instead of preparing oats at home, as restrictions ease from the coronavirus pandemic. Hopefully, there is a little less demand as people return to a more takeout restaurant diet. I disagree with that because we have a new trend, and this trend is oat milk. The demand is surging higher, the supply is nowhere to be found. It will take years for U.S. farmers to start growing oats once again to meet the demand. Therefore, this demand-supply dynamic is extremely bullish for oats futures to rise higher. What about the big casino, the options market, leading the pack at number one per usual? The hottest table in the casino, Apple. But the volume is receding, and as the volume recedes, Apple will start to top. And we're seeing weakness in the charts already for Apple as the options volume starts to recede. So again, all of these geniuses who were screaming at the top of their lungs last week that the market is rotating back to big cap technology names, and this is the reason behind the rise in Apple and Amazon stocks, forget about it. It's garbage. The stocks were moving due to the options market activities. Once these gains are already made and chips are taken off the table, the rally comes to a halt. In this case, the volume for Apple today was about 1.5 million contracts. About 78.5% of those were calls. Tesla, the souffle at number 2. And what a performance for the souffle today, leading the market higher. With about 900,000 contracts, about 65% of those were calls. And at number 3, SPSE, Virgin Galactic, and the shares were down big today, over 16% to the downside. And the reason is, here it is, Virgin Galactic falls after it gets set to sell $500 million in stock following Branson's successful flight. Translation, Sir Richard Branson went to space and broke the record for taking the highest elevated dump in history on the heads of the morons chasing the stock. I got news for you. The company has no revenue. You're investing on hopes and dreams. And when the company sees this kind of stupidity, pushing the stock price higher and higher to cartoonish levels, they will use this as an opportunity to issue more shares, aka dumping on your little head, to raise cash. And this is exactly what the AMC apes and the meme stock investors don't understand. When you push the valuations beyond any reason, the management has and must take advantage of such stupidity. In this case, Sir Richard Branson took a nice hot one from space right on the top of your head. Virgin Galactic, with about 650,000 contracts traded today, about 64% of those were calls. What about the unusual trades that took place in the options market today? Starting with the ticker CMZ. CSA. This is for Comcast, and it is a bullish bet. Now, let's stop here for a second and talk about what happened over the weekend. We learned that the new movie Black Widow, which I assume is garbage, and I wouldn't watch it even with your money because my time is valuable. But anyhow, we learned that Disney Plus, the streaming service of Disney, made about $60 million from the direct-to-streaming method on this movie alone. Meanwhile, theaters did $80 million. Folks, we talked about Disney last year, 2020, when nobody loved the stock and was trading way below the highs. Disney's dead, the virus killed Disney, yada, yada, yada. And everybody was chasing technology stocks. The future, bro. I told you back then, before Dan Loeb and all of these geniuses, the moment Disney said, we're going to charge per stream for the new Mulan movie, I said, regardless of the success of Mulan, this business model is the most genius in history. And the reason is they charge you to get into the service. You have to buy a monthly membership to get access to Disney Plus. On top of that, they charge you 20, 30, even 40 bucks a pop to watch the new releases. So they charge you on the way in and on the way out. The only downside is no popcorn. You gotta make your own popcorn. Yet people paid over $60 million to stream Black Widow over the weekend from the comfort of their homes. And now you'll start to see even Netflix starting to panic because their business model is outdated. You produce hundreds of millions of dollars, if not billions of dollars, worth of content every single year. Yet you only charge for a monthly subscription. We get to access and watch all of that content for about, 13, 14 bucks a month? Well, Disney Plus is saying, we charge you $5 to $6 a month, but you gotta pay for the new release. Pay per stream. And I believe that Netflix will follow Disney's Plus footsteps. This is the future of the entertainment industry. Forget about theaters, they're dead. It's over. From now on, we have the equipment. We have the massive giant screens, the sound systems, and we're even buying popcorn machines in the house. There's absolutely no reason whatsoever to go to the movie theater. And Disney Plus and other streaming platforms, HBO Max, Paramount, CBS, Viacom, they're all taking advantage of this new model. Another player in this new business model of pay-per-stream is Comcast. They have their own streaming service, and they will start charging per stream for new releases. Now, when investors saw the action in Disney, closing the day with over 4% gains, and the company scored $60 million in a single weekend clean. They don't have to share this revenue with anyone. Investors are looking for other streaming plays just like Disney+. Comcast happens to be the pick, at least for this trade, because they're buying the 65 calls expiration date September 17th, with expectations that the name will rise by over 11.5% by then, and they paid about 35 cents apiece to enter this trade. All in all, bringing the total for this trade to about $600,000. What about the trade or trades for Tesla, the Souffle, TSLA? We have two of them, and I think they're related. They happen to be bearish bets, and I don't understand why we're seeing these gigantic bearish bets against Tesla. Perhaps these traders know something that you and I don't know about. In this case, I see a put spread. They bought the 610 puts, expiration date July 23rd, with expectations that the name will drop by over 11% by then, and they paid about $6 a piece to enter this trade. All in all, spending about $2 million. At the same time, they also sold the 530 puts, expiration date also July 23rd. They're expecting Tesla to fall down by more than 11%, but not more than 22.5% by then. And for this particular leg, they managed to collect about $2 in premium for selling these puts. All in all, making about $700,000 in credit from this trade. So when you combine the fact that they spent about $2 million and they collected about $700,000, the total entry cost for the trade is about $1.3 million. What about the trade for the ticker ARKK? This is for ARK Invest. You guessed it, Tesla Witch Mama Kathy Wood. They're making a bearish bet here by buying the 115 puts expiration date July 30th, with the expectations that the RKK will drop by over 8% by then. They paid about $1.30 apiece to enter this trade. All in all, bringing the total to about $500,000. Lastly, what about the trade for the ticker LRCX? This is for Lam Research. And what makes this trade unusual is the fact that we don't see Lam Research as a common stock for option plays. But when we see some activities for the name, they usually happen due to a catalyst. In this case, we have earnings coming out for Lam Research. For this trade, they bought the 660 calls expiration date July 16th. With the expectations that the name will rise by over 5.5% by then, they paid about $1.60 apiece to enter this trade. All in all, bringing the total to about $600,000. Moving on to the heat map analysis. What's going on here? We're back to the bipolar market, but not by much. We're not seeing a huge difference of the performance of the technology, aka disinflationary trade, versus the reinflationary trade of financials, energy, industrials, and materials. They are slightly outperforming, but not by much. The notable activity here for the disinflationary trade is the retreat of Apple, Amazon, and the software names. On the other hand, the cyclical sector of technology, semiconductors, managed to outperform today. Whether we're talking about names like Taiwan, NVIDIA, Intel, Qualcomm, or even the manufacturers for the equipment, the likes of Lam Research, AMAT, etc. We talked about Disney, the ticker DIS, and the outperformance we saw today on the heels of the outperformance of Black Widow in the box office. Likewise, another interesting action for the day is the performance of Tesla, leading the Nasdaq with gains of over 4% today. And of course, we're searching for why. Why was Tesla up over 4% today? All we know is Reverend Elon Musk is testifying in court in Delaware today regarding the Solar City deal. But perhaps we can credit the Reverend Elon testimony optimism for the bullish action we saw in Tesla shares today. The last thing I want to mention regarding the heat map is the stealth rally in the healthcare sector and REITs. Take a look at names like AbbVie, the ticker ABBV, Eli Lilly, Pfizer. All of these names, including the health insurance plans, the likes of UNH, Anthem, was trading over 2% today. All of these names have been rallying slightly, 1%, 0.5% a day, stealth rally, while the market yo-yo back and forth between the inflationary and disinflationary trade. Likewise, we're seeing a stealth rally in REITs. REITs rallying regardless whether we have a reinflationary or disinflationary trade in the market as a whole. So watch out these two sectors. While we're still in a state of confusion regarding the monetary policy, will the Fed taper now or will it not taper now? We go back and forth. The Fed says, oh, we might taper. The market freaks out and they do a 180 and say, well, you know what? We're not going to taper. In the meantime, healthcare and REITs have been outperforming regardless. Moving on to charts, starting with the 30 minutes chart of the SPY, the S&P 500. What's new? Nothing new. We had yet another bear trap, and the SPY is building a new rally right above the bear trap, just like we saw right after the bear trap from the quad witching last month. And we're back to low volume, and the path of least resistance under low volume is higher. Now, all of this is going to start to change as we get more inflation data and earnings from banks and some companies this week, but mostly banks. So this will have a major impact on the SPY because financials, whether we're talking about big banks or regional banks, the XLF, the KRE combined have a huge weighting in the SPY. Moving on to the daily chart of the continuous contract for the SPY. Once again, the momentum indicators remain healthy, remain strong, slightly elevated, but they still have plenty of room to go. And unless we see a reversal signal from a candlestick pattern followed by a confirmation from the momentum indicators, there's nothing we can do here besides grabbing a big bag of popcorn and enjoying the show. And remember, the big bag of popcorn, you're going to have to make that yourself because we're watching from home. What about the Nasdaq, the Qs, 30 minutes chart? Look at the contrast. We talked about the strength of the SPY versus the Qs. The Qs is the weaker chart. Now, we're seeing this in action, at least from today's activities, the SPY outperforming the Qs. And we saw yet another bear flag formation in the Qs. Not as beautiful and defined as the first bear flag, but yet it counts until the chart trades above the resistance level of 363. We have a new one, and this has been confirmed not once but twice from the first bear flag, and now we have a second bear flag confirming that 363 is resistance for now. Does the bear flag means the Qs will trade down tomorrow? Perhaps, but remember, we're moving from the technicals to the fundamentals. So if inflation data comes out favorable, the Nasdaq, meaning inflation is cooling down or any hint of transitory, we will see the Nasdaq blasting higher. We're back to the fundamentals, specifically inflation. But the technicals remain important, at least for now. Speaking of, what about the daily chart of the continuous contract on the Nasdaq? Once again, elevated levels in the momentum indicators, the RSI, the MACD, all highly elevated. Now, remember, do momentum indicators give us any buy or sell signals? Not really, but they give us buy and sell zones. Big difference, folks, between a buy and sell signal and a buy and sell zone. We are in the sell zone. This is a seller's market, not a buyer's market in the Nasdaq. Just like when we talk about the housing market or the used cars market, they happen to be sellers' markets, not buyers' markets. And the reason is prices are way elevated and out of whack. When it comes to this chart we're looking at right now for the Nasdaq, we have a similar story. This is a seller's market, not a buyer's market. This is the time to start booking some gains. Remember, the Nasdaq is rallying ahead of earnings. This is a recipe for disaster because as the Nasdaq, the Qs continue to rise higher, and these individual stocks, Apple, Microsoft, Amazon, the expectations from earnings also rise higher, making the possibility of disappointment also rise higher. When you look at the charts of Apple and Amazon, the expectations are that the upcoming earnings will be extremely hot. What if they're not, though? Because a lot of these earnings when it comes to Apple and Amazon were fueled by stimulus checks. In other words, the elevated earnings from the last few quarters in Apple and Amazon were quote-unquote transitory. And this is the time, the moment of truth. Can Apple and Amazon sustain these highly inflated top and bottom line numbers when stimulus checks are starting to dry, or are they going to continue to build on the momentum from the stimulus checks? The fundamentals of inflation are extremely important, and they will dictate the destiny of the Qs and the SPY. But looking at the technicals alone, I like the SPY better than the Qs. What about the IWM? Nothing new here. We saw a slight gap down. That was closed right away, and we see the chart of the IWM consolidating as we expected around 226, 227. This zone acted as resistance before, and the expectations are it will act as a resistance now, but once broken, the next destination for the IWM will be 229. Moving on to the Dixie. What's going on here? The Dixie showing some resilience by refusing to break the very critical number of 92 as support. For now, we know there is a weakness in the momentum in the rally for the US dollar. The momentum indicators, the MACD, the RSI, are all starting to top and weaken. So we are anticipating a top in the US dollar. And this top will be confirmed once the US dollar breaks below 92. For now, we don't have this confirmation yet, keyword yet, but if it happens, you will see a sigh of relief in commodities, specifically metals. Now, remember, we're moving and shifting from the technicals to the fundamentals. The fundamentals of what? Inflation. Meaning, if the CPI number comes out too hot tomorrow, too hot will mean that tapering will happen sooner than expectations. And that could resume the rally in the US dollar. We could see the Dixie popping higher if the number comes out too hot, sparking tapering fears once again. What about gold? What's going on here? Plateauing, flattening, not looking good here, folks. We're looking for gold to start to consolidate around 1,850. It is starting to consolidate short of that number. What is gold waiting for? Gold is waiting for inflation data. It is waiting for the next move of the US dollar. Will the Dixie breaks the support of 92, or will the Dixie blast above 93? This will all depend on inflation data. Therefore, folks, we talked about it last night, the shift from technicals to fundamentals. And just a reminder, gold has two enemies, the US dollar and yields. And both of these will be impacted significantly from the slew of macroeconomics data we're about to receive this week. Here it is, yields climbing slightly higher. We are at 1.37%. This is still not good for the prospects of economic growth. The bond market is still saying, I see trouble ahead. I see deaccelerating of growth in the next few months. Will this be confirmed by the CPI number we're about to get tomorrow, or will it be contradicted by the CPI number? I am expecting a massive move in yields as a reaction of the CPI number we're about to get in the morning tomorrow. We have a resistance zone in case yields decide to continue to climb higher. The only way where we're going to see yields blasting above the resistance zone without consolidating at all, if the number comes out not too hot, but still hot, meaning not well done, but medium well. Medium well means that inflation is still growing month over month. Keyword, month over month. This is what I'm watching for. I'm not watching year over year, because we all know the base effects are tilted due to the shutdown of COVID-19. But as we start to move into June and July, those base effects go out of the window. And we have to judge the CPI numbers growth month over month. If we get a reading, say 5.3, 5.5, that will be the equivalent of medium well, and yields will spike higher. If we get a number that's too hot, 6% or more, then we have trouble here, because inflation is getting out of hand, and the likelihood is we now have a confirmation that the Fed will taper this year as soon as possible, with no doubt at all. And if this is the conclusion, it will be bad for the stock market, whether the reinflationary or the disinflationary trade. And it will be bad for yields, at least as a knee-jerk reaction, until the tapering actually happens, lifting yields higher. But in the interim, the market will panic, will say, you know what, inflation is rising out of hand, the Fed will taper, all of these prospects of economic growth are going to go out of the window. So the reaction here will be extremely important to watch. And here is the TLT bond prices weekly chart. We have a gap, which is quite unusual for a weekly chart, and the expectations are the TLT will go down to at least closing this gap. The momentum indicators have plenty of juice from a weekly charts perspective, as we said yesterday. But from a daily charts perspective, they're topping, and therefore you're seeing the TLT reversing to the downside. Once again, we're shifting from technicals to fundamentals. I feel like a parrot, but it is important to parrot this fact, because the technicals could be set up in a certain way. You could bet based on the technicals, and then the fundamentals come out contradicting the technicals. So watch out. What about the VIX? 4 hours chart. The pop in the MACD indicator is over. It resulted in about 42.5% gain, and now the VIX is retreating all the way down. We have yet another gap to close for the VIX at around 15. The assumption, keyword assumption, is that the VIX will go down, closing the gap, and then we'll take it from there. Of course, the SPY will be impacted due to the CPI number and banks' earnings. If banks' earnings fail to impress and the CPI number comes out cooling down, oh boy, the financial sector of the market will get whacked, pushing the SPY down and pushing the VIX higher. Now, this is not the scenario I'm expecting, because as we will discuss in the conclusion of this video, my expectations from bank earnings that they will come out mixed, but we have more positive catalysts than negative ones. What about Apple? What's going on here? Similar to the Qs, we're seeing the bear flag reversal, a massive pop higher in the morning that was reversed right away. This is a clear reversal, a clear sign of weakness. The good news for Apple bulls is the fact that the chart continues to hold on at around 145, which happens to be the resistance level for now. But there is weakening in the chart, starting from the consolidation between 140 and 145. It's been going on for days now, and the chart continues to struggle to break above 145. And here's the problem with the chart of Apple. When we switch to the daily chart, check out this latest rally. Apple stock rallied to the tune of about 20%. With pretty much no stop and sign. It has been rallying pretty much in a straight line, and this is a recipe for disappointment. Suppose Apple keeps this momentum all the way toward earnings. The likelihood is, even if earnings are impressive, they will not live up to where the stock is trading right now. My analysis suggests that we will see some pre-earnings profit-taking in Apple, pushing the stock slightly down, perhaps to 140, 135, but do not expect a massive sell-off in the Nasdaq before we get to earnings. We will see some pre-earnings profit-taking, and de-risking, but do not expect a massive reversal in the Nasdaq before earnings. If we see a massive reversal in the Nasdaq, the big cap technology names, it will happen due to the fact that earnings are de-accelerating. And when you contrast the de-acceleration of earnings in technology names versus the cyclical names in the market, the assumption is that the cyclical names in the market will continue to accelerate as we see more fiscal spending, specifically in infrastructure. And this week will be important, by the way, to set up the stage for the trade for the second half of this year. Do we continue with the reinflation trade, or do we shift back to technology? Or do we shift back to cash altogether because the market will lose momentum? The signs will happen starting this week. We will get inflation data. We will get banks' earnings. We will get earnings from names like Alcoa, for example. Let's say the CPI numbers come out excellent, meaning inflation is rising higher, but not too high. Banks' earnings, very impressive. Alcoa's earnings, very impressive, indicating that the infrastructure spending is boosting earnings for metals, aluminum, steel, etc. And then we get earnings from, say, Apple or Amazon. And we see that the stimulus impact starting to fade away. The stimulus impact that boosted prior quarters' earnings. Then we will have a confirmation that the market should continue in the reinflationary trade and abandon the disinflationary trade of technology. And vice versa, by the way. Therefore, once again, I'm going to keep hammering on it. We are shifting from the technicals back to the fundamentals. What about Tesla, the souffle, the surprise of the day? Everybody's looking for a reason why did Tesla shares pop higher today. Who knows, but it certainly was not due to the options market activities, because the options volume traded for Tesla was normal. And from a technical perspective, the souffle did a lot of repair work today. Number one, recapturing 657 for support. Number two, recapturing 679 for support and closing above that level. This is extremely impressive by the souffle. The problem is there is a gap. This gap will likely be filled, but not for now at least. We could see the rally goes on for a little more. But remember, 679 as a zone remains extremely difficult to pass above. So my expectations are the souffle will consolidate again. We will see what was the catalyst behind the move today. Perhaps we'll get some news tomorrow, but who knows? All I know that this move was very impressive and did a lot of technical repair for the souffle. And this is the daily chart. Once again, trading above 679. The momentum indicators are strengthening once again. The 629 support is proven to be solid for now. If the souffle passes 679, the next test will be 720. And of course, we're eyeing the weekly closing because this stock moves in weird ways from an intra-week's perspective, which makes the weekly closing extremely important because we see pumps and dumps in the stock. They push the stock higher on Monday and then they dump it by the end of the week. This has been a pattern that's been going on for a while. What about tulips? Not good here, folks. Not good. Losing a lot of momentum. There is no love. People are scared. They're not pouring money into tulips anymore, specifically when Reverend Elon is not pumping. The technicals say indecision, tilting bearish, but we are still within the consolidation zone of 30,000 as support and 42,000 as resistance. Now, you might say, wow, this is a wide range. What a genius. Well, BTC moves in wide ranges with extreme volatility. Moving 10% up or down is normal for tulips, and therefore the range of consolidation has to be wide. Yet when you read the psychology, it starts to get scary because what's keeping this chart from flushing down below 30,000 is the fact that we have hodlers, diamond hands, who are sitting on losses now, who entered the trade at around 50,000, 60,000, and now they're holding a massive bag of losses. Here's what we know. A lot of tulip traders bought via margin. They borrowed money to invest in tulips. Now they end up holding the bag. At some point, they will get margin calls. And this is when the tsunami of selling will happen, which leads me to say all the time, pretty much every single day, the laser beams have to drive the chart above 35,750 on the way to break the resistance of 42,000 as soon as possible. Because if this weakening in momentum continues, you bet 30,000 will not hold. We will see the margin calls scenario. We have a similar story with Doge. The con man is busy with memes and testimonies. He got no time to pump anymore. And therefore, we're seeing Doge melting slowly but surely, and now breaking the support of 21 cents. It is just a matter of time before we see the massive flush down. Reverend Elon is now busy. He got no time to pump for you, and by the way, it is extremely pathetic. When you read the comments on Twitter, all of these morons, the geniuses that they are, begging Reverend Elon to pump Doge. Well, he tried a few times, but the man lost his magic. And now, of course, he's occupied with Sir Richard Branson and Sir Jeff Bezos going to space before him. Why? Why are they going to space before me? All of these asshole billionaires obsessed with going to space. Perhaps they're looking for a new planet to destroy. What about AMC, Planet of the Apes? You know, I gave you guys the bull flag formation. I'm trying to be on your side. But forget about it. I think you guys are going to lose this battle, and therefore I'm removing the bull flag out of the picture. The good news is that there is the potential of higher lows still, so there is hope to cling on for the apes. But boy, this is melting, and we have bad news for AMC, by the way. Remember the shift from from technicals to fundamentals? Well, here's the fundamentals for you. And this is an article written by the donkeys, by the way. Hashtag AMC undefeated. AMC stock is in focus after huge Black Widow debut. AMC stock appears to be presenting an opportunity, a buying opportunity, after a big post-pandemic weekend. Really? This is bad news, you morons, not good news for AMC. Because here are the facts. Black Widow sets pandemic record with 80 million in theaters and 60 million in streaming. This is bad news for AMC and movie theaters in general. That even after the reopening, people are still streaming from home. We're lazy, folks. It is more convenient. We have massive screens, sound systems, popcorn machines. And you know what? At the comfort of your couch, you can spread your legs, relax your feet, be a loud asshole. Doesn't matter. You can do whatever you want at the comfort of your home. But in the theaters, who wants to go there with COVID, Delta variant, and all of these nasty assholes in theaters? The fact that the movie makes almost the same revenue from streaming as it made from theaters, that tells you that the theater business is dying. And there is no revival here, folks, unless they get bought by Netflix and Amazon. And Netflix and Amazon start to screen. This is an old word. Screen movies for free in the theater. What this tells me is Black Widow should have been able to make about $140 million in the box office, but it lost $60 million due to streaming. This is bad news for AMC. You think the apes care? Of course not. They're still holding on the dream that if they huddle with diamond hands, someday the miracle will happen. Jesus Christ will come down and force the shorts to cover, and we will see the mother of all short squeezes, and AMC will trade at $100,000. What a bunch of fools. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the CPI and core CPI, critically important numbers because this is a real test for the transitory argument. And by the way, I'm not watching the base effects. I'm not watching the year over year. I'm watching the month over month number because if the number comes out higher month over month, then we have a big problem here, folks. Inflation is not transitory. It is increasing month over month regardless of the base effects, and the tapering will happen sooner than expectations, which will make the market's reaction extremely tricky, by the way. So hold that thought. Let's stick to the facts here. These are some of the non-cooked components of the CPI. Airline fares, apparel and household goods, postage, prescription drugs, and used cars and trucks. Let's talk about airline fares. What do we expect for the month of June? Here it is. Why airfares will likely keep getting more expensive. And this is an opinion. What about the facts? From the Chicago Tribune. Airfare bargains vanishing as airlines seize on surging summer demand. We're seeing a massive recovery in airline travel. And we had the holiday in June combined with the shortage of staff leading to a cancellation of a lot of flights. Meanwhile, ticket prices rose significantly higher. So my expectations here that airline fares will come out higher month over month. What about apparel and household goods? Now, this is tricky because you can look at the retail sales data, they're softening, and perhaps the prices are going down as retail sales activities start to slow down. However, the catalyst behind the rise in apparel and household goods prices is shipping prices. And this is the problem we're facing right now. Cotton prices to rise due to the textile industry's demand booming over supply. So we know for apparel at least, cotton prices continue to rise higher. In addition, shipping prices haven't slowed down at all. They're actually increasing higher. Container shipping prices skyrocket as rush to move goods pick up. Persistent supply chain bottlenecks are driving up rates, and the shipping sector sees no relief on the horizon before 2022. Here's another headline. Cost to ship a box load of goods to the U.S. from China nears $10,000. This is insane. Another headline. 229% surge in China-U.S. shipping costs drives inflation pressures. And this is from the Time. Surge in shipping costs globally could cause price hikes from coffee to toys. Transporting a 40-foot steel container of cargo by sea from Shanghai to Rotterdam now costs a record $10,522, a whopping 547% higher than the seasonal average of over the last 5 years. Wow. With upwards of 80% of all goods trade transported by sea, freight cost surges are threatening to boost the price of everything from toys, furniture, and car parts to coffee, sugar, and anchovies. Perhaps this one is not a bad one, because what a disgusting thing to eat, anchovies. Compounding concerns in global markets already bracing for accelerating inflation. In 40 years in toy retailing, I have never known such challenging conditions from the point of view of pricing, said Gary Grant, the founder and executive chairman of the UK toy shop The Entertainer. He has had to stop importing giant teddy bears from China because the retail price would have had to double to add in higher freight costs. Will this have an impact on retail prices? My answer has to be yes. So once again, when we go back to the components, the non-cooked components of the CPI, when we talk about apparel and household goods, the expectations are these prices will climb higher month over month. Now, what about postage? Here it is. USPS says stamp prices will rise this summer under DeJoy's 10-year overhaul plan. So here's another one. Postage costs rising higher. What about prescription drugs? Perhaps we can get some relief from this one. Nope, not really. Here it is from the AARP. Prescription drug price increases continue due to outpace inflation. New AARP report shows even during pandemic, consumers have had to pay more for medicines. Now, what about used cars and trucks prices? We talked about this as being transitory because look at the price changes year over year, specifically for pickup trucks. Now, the expectations are we have a shortage in used cars and consumers went out of whack. They started paying more than the sticker price for used cars than when they were new, which is absolute insanity. But the point is, you're not going to go out and buy a pickup truck every month. At least I hope not. And therefore, the inflation of used car prices is likely to be transitory. And indeed, when we look at the Manheim Value Index for used cars, we see a slight dip in June. Just a tiny bit, but perhaps prices have already topped. So the transitory camp will have something to hang their hats on. They will have a source of orgasm when we get the number tomorrow, and that number will be due to used cars prices topping. Now we have a few miscellaneous items that will impact the number. For example, lumber prices officially wiped out all of the staggering gains for the year. On the other hand, we have rents rising significantly higher. While the housing mania cools down, the mania is shifting to the rental market, and we're seeing rent prices rising significantly higher. Another piece of news that could impact the CPI number, say it comes out too hot, the transitory camp of Fed apologists could use this piece of news as relief. President Biden's new executive order could save you money on airfare, medications, and more. The catch is, he's talking about the government reducing the cost by assuming some of that cost. Now, when the government opens the cookie jar for everybody to stick their hand into, prices will actually go higher, not lower. Look no further than the health insurance Medicare system. We have scams all over the place, with doctors charging an arm and a leg for simple procedures because they know that the government is paying. And the government, they get the bill, they sign it, They pay the check, they don't give a rat's ass who's going to pay for it, or whether they have to bargain or investigate fraud, because money is easy. You just print it out of thin air. And before your blood starts to boil, I know that some of the Biden's executive actions will address importing medications from Canada to reduce prices. I get all of that. But when they say saving us money, they don't mean they're going to slash those prices or place price control. They will just assume part of the cost. The government will assume part of the cost to give you and I relief. But in doing so, they will actually achieve higher prices, not lower. And here it is from the New York Fed survey. Inflation expectations surge, heading new high for the New York Fed survey. The expectations for June showed that median inflation expectations over the next 12 months jumped to 4.8%. The Fed says 2%. We got it. Trust us. And if it goes over 2%, we got the tools, bro. Okay? What is the formula you're using to determine whether 2.5% is too hot, 4% is too hot, 5% is too hot? What is the threshold when the Fed says, okay, we're now averaging way above 2% and we need to pull back? Where is the damn formula? The Fed says we're not going to use any formula. We're not guided by any formula. We're just going to eyeball inflation at 2%. Good luck. And here's from Bank of America on the CPI number. We expect core CPI to rise by 0.5 percentage point month over month in June due to rising used car prices and travel related costs. This would push the year-over-year percentage rate up by 0.3 basis points to 4.1%, the highest reading since December 1991. If this happens, we know for sure that the transitory argument is indeed bullshit. The question is, how will the market react? Because remember, if the number comes out too hot, the market is not going to like that, because the market will look forward and sees tapering, and tapering is not good for the market. Now, the only disagreement I have with Bank of America is rising used car prices. I showed you the data. We have a slight dip, a small, tiny one. So I'm expecting that used car prices will go down month over month. But travel costs, shipping costs, prescription medication costs will fill the void and keep the CPI reading elevated. Now we have the cooked components of the CPI. These come out from the quote-unquote surveys that the cooks at the Bureau of Labor Statistics conduct. How are they going to cook the numbers here? We know that the Biden administration likes their numbers to be medium, not too hot, not too cold. If the number comes out well done, meaning too hot, tapering expectations will rise higher. And this will be a disaster scenario for the market. If the number comes out rare, meaning too low, too cool, that will also be a disaster scenario for the stock market, because yields will collapse and the message from the bond market regarding the acceleration of growth will come to light, and stocks will not like that. Perhaps some big cap technology stocks will gain as investors look for quote-unquote safety. But we know that this is not a likely scenario, because looking at the facts, it is extremely hard to come to the conclusion that the number will come out rare. What is the ideal scenario for the market? Here it is, medium rare. The cooks have to give us a number medium rare, meaning a slight decline month over month. And that will keep two arguments alive. Argument number one, the economy is still recovering. We're seeing healthy inflation. Prices are surging higher. But on the other hand, you have argument number two. We're seeing signs that the inflation in prices is indeed transitory. So you get the best part of inflation, the early part of inflation, but you keep the bad, because by the time we get to the later stages of inflation, which are the bad stages, guess what? Inflation will be transitory, and we're never going to visit the bad stages of inflation. We're just going to keep the good ones. Now ask yourself, are you that stupid? Regardless, the cooks should give us a number that is medium rare to please the market. Lastly, what about the earnings calendar? Tomorrow we have GPM, JP Morgan, we have Fastenal, FAST, another inflationary stocks, tools, nuts, bolts, and then we have Goldman Sachs, in addition to PepsiCo. On Wednesday, we have Delta Airlines, Bank of America, BlackRock, Citibank, Wells Fargo, and Charles Schwab. On Thursday, we have Alcoa, US Bank, United Health, and Morgan Stanley. Now, what are my expectations regarding banks' earnings? The positive catalysts, starting with the IPO mania last quarter, in addition to the options mania, and on top of that, you have the Fed stress test, which pretty much gave the green light the share buybacks and increasing dividends. So my expectations are we will hear some buyback plans from big banks and they will be gigantic. So this is a positive catalyst for banks. Likewise, cash reserves remain healthy and pretty much the government banned bankruptcy with the Fed printing money out of thin air and bailing out everybody. But we also have some headwinds. Number one, the collapse of yields in this quarter, in addition to the Archegos disaster, which is still impacting names like Credit Suisse, for example. So what do we do with this information? Perhaps I'm not so bullish on regional banks because regional banks depend on yields tremendously. And if yields went down in the quarter, the assumption is that these regional bank earnings will come out soft. I happen to own one regional bank in my portfolio, US Bank, USB. So what am I doing to protect this investment? I am selling calls out of the money and I'm using some of the proceeds to buy puts as a protection. What names in financials that I'm bullish on? The names that will benefit from the IPO, options manias, and stock buybacks. In this case, a name that I own, Goldman Sachs. I'm still bullish on Goldman even though the chart went to the moon in a stratospheric levels. But think about it. Yes, yields went down, but Goldman Sachs is more dependent on the IPO and options mania, in addition to the buyback news. So I expect Goldman Sachs to give us really good numbers this quarter. Whether the stock is going to react positively or negatively, that remains to be seen. My hedging strategy is the following for Goldman Sachs. I am selling upside calls, covered calls, and I am also selling way out of the money puts in case the stock goes way down. So in my regional bank strategy, I am selling an upside call and I am buying put options with some of the proceeds from selling the covered call. In my investment bank strategy, Goldman Sachs or Morgan Stanley, doesn't matter which one you own. I am selling an upside call, a covered call. I'm also selling out of the money puts to raise cash, and in case the stock drops down significantly, even though we have good earnings, I will have the option of exercising the put options and adding more shares to my holdings, aka buying the dip. Anyhow, folks, this is all I got for you tonight, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.